Hello, everyone, and welcome back to Daily Dollars. Today, we've got a huge update that could change the game for millions of Americans when it comes to taxes. Yes, everything from your paycheck and side hustle to your retirement income and family budget is on the table. House Republicans are pushing a bold tax proposal that, if it passes, could completely reshape how you file your taxes and plan your finances starting as soon as 2025. Whether you're working full-time, running a small business, retired, or juggling the demands of family life, this could impact you in ways you haven't imagined yet. So, before we dive into all the details, make sure to hit that like button and subscribe to Daily Dollars so you never miss any updates. All right, let's get to it. Let's start with the proposed bill. At the center of this bill is a push to make the 2017 Tax Cuts and Jobs Act permanent, a law initially enacted during the Trump administration. Since 2018, these cuts have kept federal income tax brackets lower for most Americans. However, they are currently set to expire in 2025, which would mean tax increases for a majority of taxpayers if Congress doesn't act. According to a recent analysis by the Nonpartisan Tax Foundation, more than 60% of taxpayers could face higher taxes starting in 2026 if these cuts are not extended. The current proposal aims to preserve those rates, ensuring that working Americans can continue to benefit from lower tax brackets and providing predictability in a time of economic uncertainty. But this new bill goes far beyond just preserving the 2017 tax rates. The House Ways and Means Committee projects that the average taxpayer could see a reduction of about $1,300 annually under this legislation. In addition to rate extensions, the proposal folds in several new provisions that stem from campaign promises, particularly those made by President Trump. Among the most talked about additions are temporary deductions for tips and overtime pay, expanded child tax credits, enhanced standard deductions, and even a new tax break for car loan interest. Let's begin with one of the most significant components, the enhanced standard deduction, a tax break that reduces your taxable income without requiring itemized deductions. Under the proposed law, from 2025 to 2028, the standard deduction would increase across all filing categories. Single filers would see it rise from $15,000 to $16,000, heads of household from $22,500 to $24,000, and married couples filing jointly from $30,000 to $32,000. For context, a single worker earning $50,000 annually would now only be taxed on $34,000 of that income, potentially saving hundreds in taxes each year. These higher deductions are designed to ease the burden on everyday taxpayers and help simplify the filing process. For families, the bill delivers a much-needed update to the child tax credit. Instead of reverting to the $1,000 per child credit in 2026, the bill not only preserves the current $2,000 per child credit, but increases it to $2,000 between 2025 and 2028. After that period, the credit would return to the $2,000 level. For households raising children, this temporary boost could provide significant annual relief, especially when combined with other family-related deductions. Another area getting attention is support for tipped workers, such as restaurant staff, hotel employees, rideshare drivers, and beauty professionals. Originally left out of the draft bill, tax relief for tips made it into the legislation through a chairman's amendment. From 2025 to 2028, workers in traditionally and customarily tipped industries could deduct tip income from their federal taxable income. Notably, this deduction extends to self-employed individuals, like gig economy workers, and excludes those earning more than $160,000 annually, keeping the benefit focused on middle and lower income earners. It's important to understand that this is a tax deduction, not a full exemption. That means workers still have to report their tips when filing taxes, and they'll still have to pay state and local taxes, along with payroll taxes like Social Security and Medicare. This distinction is key because while these deductions reduce taxable income, they don't change your obligations toward the programs that fund your Social Security retirement and disability benefits. The bill proposes expanding the existing Section 45B tax credit, which currently helps restaurant owners offset payroll taxes on tipped wages, to include other service industries such as barbers, hairstylists, nail technicians, and spa workers. The bill also targets overtime pay, another campaign promise turned legislative proposal. Much like tips, workers could deduct the overtime premium from their federal taxable income for the years 2025 through 2028. Again, this would lower taxable income but not eliminate the need to report overtime or pay payroll taxes. Regular wages would still be fully taxed under existing rules. This brings us to payroll taxes, which are directly tied to your Social Security and Medicare benefits. Employees pay 6.2% of their income for Social Security and 1.45% for Medicare, with employers matching those contributions. Self-employed individuals must cover both halves, 12.4% for Social Security and 2.9% for Medicare, under the Self-Employment Contributions Act. While deductions on tips and overtime can reduce your federal tax bill, they don't impact your Social Security contributions, which remain vital for maintaining your future retirement benefits. One of the more buzzworthy campaign promises was the elimination of federal taxes on Social Security income. While appealing, this has not materialized in the current legislation. Instead, the bill offers a modest $4,000 deduction on Social Security income for 2025 through 2028. This tax break can be used even if you don't itemize your deductions, but it gradually phases out for people with higher incomes. Since it's a deduction, not a direct refund, many low-income retirees who mainly rely on Social Security might not see much of a benefit from it, something that has sparked concern among advocacy groups. Small business owners also stand to gain from an increase in the pass-through deduction, which allows entities like sole proprietorships, partnerships, and S-corporations to deduct a percentage of their qualified business income. The bill raises the deduction from 20% to 23%, providing more breathing room for local entrepreneurs and service providers. For working-class consumers, another unique proposal allows for a deduction of up to $10,000 in car loan interest, but only for vehicles assembled in the United States and for those earning below $100,000 or $200,000 for joint filers. This provision aims to offer relief while encouraging support for domestic manufacturing. For those focused on estate planning, the proposal would permanently raise the federal estate tax exemption from the current $13.6 million to $15 million for individuals and $30 million for couples, starting in 2026. These exemptions would also be indexed to inflation moving forward, allowing families to pass on wealth with less tax liability. However, not everything that was promised has made it into the bill. Most notably, the full elimination of taxes on Social Security benefits remains absent, likely due to concerns that doing so would accelerate the depletion of the Social Security Trust Fund, a politically sensitive issue with far-reaching consequences. So, where does the bill stand now? As of today, it remains under debate in the House of Representatives, where Republicans hold a narrow majority. House Speaker Mike Johnson has expressed his intent to push the bill to a vote by Memorial Day, after which it would need to pass through the Senate. Some Democratic lawmakers have raised concerns about how to fund the estimated $880 billion cost of these tax cuts, particularly if it means making reductions to social programs like Medicaid and SNAP. It's important to remember that these are proposals, not guarantees. Until the bill becomes law, nothing is final. And even if passed, many of these changes are only set to last through 2028. That's it for today. Share your thoughts in the comments below. If you found this breakdown helpful, please like this video, subscribe to Daily Dollars, and turn the notification bell on. Thanks for watching. I'll see you in the next video.